Hello, I'm Carolina Martinez, CEO of Cameo, California Association for Microenterprise Opportunity. Cameo is California's statewide small business network made up of over 300 organizations, agencies, and individuals dedicated to further small business development in California through small business financing, such as credit, technical assistance, and business management training. Together, our members serve more than 87,000 small businesses annually. I'm really pleased to moderate this all-star panel that will discuss the lessons we can learn from the issues in the early rounds of the federal Paycheck Protection Program to create a more equitable lending landscape for underinvested entrepreneurs moving forward. Our panelists have been working on the front lines during this pandemic to help small businesses and underserved entrepreneurs survive. They have also been generating new ideas and models to better serve women entrepreneurs, immigrant entrepreneurs, and entrepreneurs of color, in particular during the pandemic and beyond. Let's have our panelists introduce themselves before we get into the meat of our conversation. Aisha, let's start with you.
Sure. Hello, everyone. My name is Aisha Benson. I'm the Chief Operating Officer of True Fund Financial Services. We're a nonprofit community development financial institution that provides responsible and affordable capital to nonprofit and for-profit businesses that are financially viable but don't qualify for conventional financing. And we are located in New York. We serve New Jersey. We serve Alabama, Louisiana, Texas, and Georgia. And nationally, we serve businesses through our structured finance platforms. That's new market tax credit financing and equity financing for diverse developers. And really, our mission is just to close out racial and economic disparities to create more sustainable and equitable society through our activities.
Thank you, Aisha. Let's go with you, Beth.
Hi, everyone. I'm Beth Bafford. I'm a Vice President of Syndications and Strategy at Calvert Impact Capital. Calvert Impact Capital is a nonprofit investment firm located in the Washington, D.C. area. We've been around for about 30 years investing in community and economic development across the U.S. and around the world. And like Aisha, our mission is really to create market mechanisms that allow our financial system and our economy to be more just and to work for more people more often.
Thank you, Beth. And last but not least, Luz.
Good morning, everybody. I'm Luz Urrutia. I'm the CEO of Acción Opportunity Fund. We are also a nonprofit CDFI founded 25 years ago and 100% dedicated to driving economic mobility by delivering responsible and affordable lending, technical assistance, coaching, and support networks to help low-income, low-wealth, and other disadvantaged communities join the economic mainstream that have been left behind by mainstream financial institutions. Nearly 90% of the small businesses that we serve are people of color, women-owned, or immigrants.
Thank you all so much for joining us today. When COVID-19 hit and the world began shutting down, it became clear immediately that along with the health crisis, we were facing an unprecedented economic crisis, and that small businesses in particular were going to be devastated. In response, the federal government moved to create a program to support the small businesses, and the Paycheck Protection Program was created with the intention of helping small businesses stay afloat and employees keep a paycheck. The intent was good, the implementation fell terribly short, as we all know. To disburse PPP loans, the Small Business Administration relied on traditional lenders. In the first round of PPP, non-traditional lenders like community development financial institutions, minority depository institutions, and others were left out. It wasn't until the second round that they even got a foot in the door. The loan forgiveness rules also were unclear, and the result was risk-averse banks focused on their most secure existing customers. Big businesses received more than half of the PPP funds, while many small businesses were left out entirely. This problem was especially pronounced for low-income communities, women, immigrants, and communities of color. For instance, only 5% of businesses that received PPP loans were women-owned. A survey conducted by Color of Change found that only 12% of Black and Latinx-owned businesses were successful in receiving the full funding amount that they requested, and a secret shopper study conducted by the National Community Reinvestment Coalition found a bias in favor of white borrowers at banks. By overlooking non-traditional financiers, government's relief efforts missed a huge swath of the small businesses most in need. Fortunately, the flawed rollout of the PPP put non-traditional lenders in the spotlight and made people get creative. And I'm really glad about this conversation. So, Aisha, let's start with you. Could you describe what you saw happening to under and uninvested entrepreneurs during the early days of PPP? What did they experience when they tried to get a PPP loan?
Sure. What we saw were huge disparities. We saw very small businesses, I'm talking about businesses with less than 5 employees, and minority-owned businesses, particularly immigrant and Black-owned businesses, hardest hit. There were high levels of anxiety, high levels of uncertainty, as well as a general lack of preparedness on the part of these businesses. And I think this is largely attributed to low levels of business resiliency. And what I mean by that are, limited cash in the bank, a high tendency towards informal business practices, no business continuity plan, lack of formal relationships with banking partners, and just the systemic, issues that were really just being exacerbated by the pandemic. And these factors contributed to low approval rates, PPP approval rates, and even for those that received a PPP, the amounts were lower. And there were higher rates of business closure among these businesses. And this is really borne out in a research study conducted by 60 Decibels on behalf of select CDFIs. When we look at TrueFund's data, for example, so maybe if we could go to that slide here, we see that Black-owned businesses were disproportionately unprepared for the challenges of COVID-19. More than 2/3 of Black-owned businesses said that they were unprepared, compared to just a little over half for white-owned businesses. And this really bled into temporary business closures as well as longer-term business closures, where we see that 41% of businesses say that they would have closed without assistance from the Paycheck Protection Program. And this is really in alignment with the Federal Reserve Bank's data that showed that Black businesses experienced the most acute decline, with 41% of business closures compared with a 17% business closure rate for white-owned businesses. And when we really look at this next slide, helps us to understand the importance of CDFIs coming into the picture. Through our accountability to minority communities, our relationships there, our targeted outreach, we were really able to drive PPP dollars into the hands of minority and female entrepreneurs. In fact, this slide says that, more than half of our lending, went to minority and women-owned businesses, but 87% of TrueFund's PPP dollars went to minority-owned small businesses, 62% to Black-owned businesses, and 24% to Latinx-owned businesses. And we did almost 1,200 PPP loans, so this is very significant. And I really just want to reiterate that the PPP clients of CDFIs are largely unbanked and underbanked. They didn't have XYZ Bank calling them to apply, and they didn't have anybody at XYZ Bank to call. So whether they Googled an online lender or an online lender contacted them, quite frankly, we have to say that there was just an ineffectiveness and an irresponsibility on the part of certain lenders that left many small businesses in the dark and in some cases in a disadvantageous position. And this is why it's so great that many of these businesses found their way to a CDFI so that we could help them. Some we couldn't help because there was a loan already on the books when we went to process it through the PPP system. And it took a lot of work to really get these businesses the assistance that they needed. And this, again, really highlights the importance of CDFIs as lenders in these federal programs. As the next slide shows that CDFIs provide a better experience with strong customer service and a high-touch TA model that really increases the flow of capital to underserved entrepreneurs. We spend hours really helping entrepreneurs through the application process. And the business advisory support that we give is critical given the lack of clarity that was in the SBA process through a good portion of the time the applications are open, and the lack of preparedness and business characteristics that I shared earlier. And so finally, I love this last slide here that shows that 96% of the PPP clients were new to TrueFund. They came from a trusted network of partners, but they were in fact new. And so there are three important points to highlight here. The first is that a healthy entrepreneurial ecosystem can break down structural and systemic disparities. So we work very closely with local community organizations and business support organizations to be able to serve these clients. The second is that though these entrepreneurs are underinvested, they are also underserved. They need services, which CDFIs provide. Help with cash flow and business planning, credit counseling, and a host of other supports that wrap around our loan application process and the capital that we provide. So if CDFIs are going to comprehensively serve these businesses, and it might be too early in the panel to really start hitting home these points, but I'm going to say it anyway, we need to be adequately resourced to handle the influx of these new clients and the totality of their needs. We're being stretched, not only on the client-facing end, but when it comes to our back office support functions as well. So we really need additional programmatic support and loan capital to continue to help these businesses survive and thrive.
Thank you, Aisha. It's never too early to keep pushing those messages. And we do have more than 300 members that work with small business owners directly. And we saw what you were describing, Aisha. When PPP started, we all began hearing about problems right away. Many small business owners didn't know where to start. If they want a traditional bank, they got confusing and conflicting messages about whether they could apply or not. They did not know what the requirements were. And many of our members told us that they were very concerned that the small businesses they work with would not know what to do or even how to begin and would be left behind. CAMI and its members had a three-pronged strategy for improving PPP. The lenders in our network applied right away to be eligible to the PPP loans so they could help their clients and others. The business assistance organizations held information sessions, connected small business owners with community-based lenders that were doing PPP for new clients, and walked small business owners through the application. And we all worked together to advocate with the SBA and Congress to make improvements in the program so that the smallest of businesses and most under-resourced businesses could access the program. But it kind of bears the question, and I'd like to go to you, Luz. Why did this happen? What were the assumptions that the designers of the PPP made that created these problems? And maybe could you elaborate and what were some of the efforts that make PPP lending more accessible? Luz?
Yes. I'm sorry. I'll reinforce, a lot of what Alicia said. There's this general assumption that everyone, especially business owners, have a relationship with a bank, and that is certainly not the case, as we saw. When COVID hit and policymakers were defining plans to help small businesses, the millions of people who are shut out of our traditional financial system were clearly not top of mind. According to the Federal Reserve study in 2019, only 23% of Black-owned firms had previously accessed bank financing, compared with 46% of white-owned firms. And that means that small business owners of color are not accessing their financing from traditional banks. Instead, they are going to alternative lenders because traditional lenders don't lend to people of color at the same rates as their white counterparts. As we saw when the pandemic hit, Congress stepped in to help small businesses that were reeling from the shock of lockdowns across the country, and a giant spotlight was shown on that disparity and the systemic bias in our financial system when it comes to accessing affordable capital. PPP was a perfect example of how businesses who don't have a relationship with traditional banks have been left behind. Many of the big banks, as we know, only served their customers that either had active bank accounts or large credit relationships. And the larger businesses that have these types of relationships and, accountants and lawyers to help apply were at the front of the line for PPP loans. What's more, 90% of Black-owned businesses don't have employees. And the PPP was originally available for employee businesses only, which again shot out a huge percentage of Black-owned businesses. CDFIs, minority deposit institutions, fintechs, were not authorized to lend in the first round of PPP, and meaning that all the people we serve who did not have those relationships with traditional banks weren't even in line to get a PPP loan. And those businesses, as we all know, were the ones that needed this assistance the most. They were the businesses that had an average of 15 days of cash reserves. At Acción Opportunity Fund, we joined numerous CDFIs, MDIs, and fintechs to advocate on behalf of the business owners in the later rounds of PPP to put them at the front of the line. In the first round, we worked with CDC to redirect all the customers that were coming to us that we could not serve. And when we finally received PPP approval, we partnered with organizations like Ramin, America, CRC, and Gusto, and others to help their customers get through the process. As Alicia mentioned, it was a very tedious process and they needed a lot of help. We did over 1,600 PPP loans. Our average PPP loan was about $16,000, much lower than the national average of $73,000 during the second round of the program, which again reflects that CDFIs are really focused on serving the smallest of the smallest businesses. So I'm going to go ahead and say it, now more than ever, it's really important that we ensure that CDFIs have the resources, loan capital, equity, net assets, government support that they need so that they can help support these underserved and underrepresented businesses in local communities and rebuild them.
Yeah, thank you, Luz and Beth. I'll go with you. This whole experience, as Luz just mentioned, really shone a light in some of the flaws that have long plagued our financial system. But it also gave rise to partnerships and innovative programs to help fill the capital void for the small businesses struggling the most. And these new programs have real promise in changing the small business capital access landscape for the better. You've been at the forefront of a number of public, private, and private philanthropic programs across the nation. Could you tell us about those and what you hope that these can do for the small business capital landscape moving forward?
Yeah, absolutely. I mean, I think as has been mentioned, we recognized we have been a lender to CDFIs like Opportunity Fund and True Fund for over 25 years, and we knew that as soon as this hit, even before PPP was signed, that top-down efforts from the federal government through a distribution network like large banks were automatically going to leave people out, and that one product was not going to solve all problems. And so we wanted to create something that had an intentional focus, an intentional design built by and for local community financial development institutions and other community finance organizations in reaction to what they were seeing in their markets. So instead of having this, designed from the top down, really looking at how do we create programs led by and created for CDFIs so that they can lean into this crisis and have the resources to support their communities, their small businesses in their areas of service at this time, because there was a large fear in the market when COVID hit, not only about the success and the survival of small businesses, but about the success and the survival of CDFIs. And these are institutions that had balance sheets full of small business assets or other assets that were uncertain, at risk. And so we needed to make sure that they were strong and they were solidified so that they could really lean in and support their communities at this time. And so what we did was start to experiment with a model really brought built to create a supportive ecosystem around the CDFIs so that they could go out and do what they do best. And so we created kind of this three-pronged model we call the Community Recovery Vehicle. First kind of piloted in Chicago and then tested more broadly in New York, which brings essentially a capital resource, low-cost liquidity that enables CDFIs to lend off balance sheet. It brings technical assistance support, wraparound services so that the CDFIs can focus on lending, and they have networks of technical assistance providers to support with pre-loan assistance and kind of the hands-on support that's needed. And the technology solution brought by our partners at Community Reinvestment Fund to really allow for a streamlined customer experience, really easy and accessible and understandable process for small business owners that connected those small businesses in need directly with the CDFIs, so they didn't need to spend a lot of time marketing or finding those business owners. As I mentioned, we kind of started experimenting this and set up this model in New York last May in close partnership with the state. We have since worked with a broad coalition of lenders, organizations, including Cameo and others, to create the California Rebuilding Fund with the iBank in California. We are now launching an effort across 15 states across the South called the Southern Opportunity and Resilience Fund, and we're developing the model right now in Washington State. But the biggest thing we've learned from these programs and these collaborations is really the importance of collaborative design. So if you move to the next slide, this is kind of all of the CDFIs that have been working with us on these programs across the country, which we've kind of developed the model really by listening to them. So listening what they're seeing in the market, what their small businesses need, what the product design needs to look like. Another big thing PPP taught us was that product design is extremely important. The flexible use of proceeds, the size of the loan opportunity, the flexibility in repayment schedules, those are all really important to make sure that you're offering a product that is beneficial for the largest possible set of small business owners. And so that is feedback that we took from these organizations that are working across the country to make sure that we were designing this intentionally to serve the communities that they're built to serve, which is low-income communities and underbanked communities across the country. If you move to the next slide, one of the things that I think we have learned most from this is just how amazing our CDFI partners are. And so, what we see, in crisis, crisis reveals character. The character of these organizations, the dedication, the perseverance, the scrappiness, the innovation, and just the passion that they've brought to this work, so that they could drastically extend themselves in service of their communities has just been amazing to witness. So what this chart shows is basically for the 4 small business lending CDFIs that are lending in New York, It shows their 2019 volume versus their 2020 volume. And you see the heroic expansion of work, increasing capacity, increasing staff, crazy hours. I know Aisha and Luz can attest to the pain of this chart, but it was amazing to see just how much they turned on because they knew their communities were in need and needed them in this moment. And so I think what this shows me is just how much they can stretch if we really give them the resources and the support and the infrastructure around them to help develop and create a path for their success. And then lastly, we have been working with folks like Axion Opportunity Fund, Cameo, True Fund, and have just learned so much about their resiliency and really what role they need to play going forward in our community, in our overall financial system. This is something that, as Luz and Aisha mentioned, this is the public awareness of just how broken our banking system has become is one of the silver linings of the last year. People now understand just how broken that system is and just how disconnected millions and millions of Americans are from accessing quality and affordable financial products. That deserves enormous amount of attention. It deserves an enormous amount of public support, public sector, and public awareness. And I think if we want to be creating a more just economy, if we want to be creating a more equitable and an even playing field for entrepreneurs across the country, that is something that we all need to recognize. And the last slide on here is just a snapshot of who we've been able to reach through these programs, just to illustrate kind of when you do build intentionally, when you do build in partnership and in collaboration with the economic heroes like the women on this phone call, you get amazing results. So we've served over 3,200 businesses to date. 70% of those loans have gone to businesses owned by women or people of color. 51% have been located in low-income communities. 90% are 10 or fewer employees, and 88% have less than $1 million in revenue. When you define the unbankable population, this is what we're looking at. And so, I think what we have learned through this process is how do you take something like PPP, quickly learn the lessons of what was good and what was challenging about that kind of program, and how do you take the kind of urgency of the moment to create new models and support around what our future should look like, so we don't go back to kind of pre-crisis normal.
Thank you, Beth. And this is so great to see all this information. And I'd like to just move now to Luz. I know Axion Opportunity Fund has been part of these programs. Could you share with the audience what has been your experience with these programs and how do you see them playing out in the long run beyond the pandemic?
Sure. So, we are extremely pleased with the initial results of these programs. And a shout out and very grateful to Calvert and to Beth for her endless and selfless hours of work, trying to bring all the resources that putting something like this together entails, to, CRF, the rest of the CDFIs. I think that what we all saw was how it didn't matter who did it, we just needed to get it done. And we all came together with one common vision. It was to help small businesses access the resources that they need in order to rebuild and get out of this crisis and be able to go forward for the long term. To provide some context, prior to COVID, small businesses, especially those owned by people of color, women, and low to moderate income, already were facing significant challenges, right, when it came to accessing responsible and affordable capital. In fact, the small dollar lending market gap for small businesses under $100,000 was estimated at $87 billion. And so post-COVID, we believe that this challenge is already getting worse. and the landscape will be dramatically altered. Banks are going to continue to further tighten their credit boxes for the risk that they perceive in the market. And the for-profit non-bank lenders, some of whom are responsible, some of whom are not responsible, will also retrench or fail due to their own portfolio loan losses, to their own challenged capital structures. And so the result is that these underserved small businesses will have an even more difficult time trying to access the capital to help them weather and rebuild from the pandemic. So the program that Beth and the programs that Beth is talking about really leverage existing infrastructure of CDFIs, which have deep ties in the communities most in need, so that we can effectively deploy capital. And this structure offers CDFIs, a customer acquisition platform, which is one of the many challenges that CDFIs have trying to scale and trying to access customers. It also offers low-cost capital and the philanthropic resources to support the work that CDFIs need to do to underwrite the loans, fund the loans, service the loans. And it creates, the benefit of a secondary market for CDFIs to be able to transfer those loans to a special purpose vehicle so that we can free up the balance sheet and continue to lend. So we see a tremendous potential for these programs. We believe that this is only the beginning. You saw the statistics that Beth has provided. These are the businesses that really need the support more than any other, and now more than ever.
Thank you, Luz. And it's so good to hear you talk about the support to the small businesses, and also Beth mentioning how important it was to provide that support for CDFIs to be able to continue that work. So it's kind of a win-win project. That's really great. Aisha, you've also been a participant in these programs. Could you share with us what kind of impact do you see moving forward for the folks you represent?
Sure. Let me first say that there is a strong continued need for these programs. The research that I referenced earlier, I had 2 additional slides here that I just wanted to put up and help everyone understand what business owners are saying. They're saying 13% of customers say that they are very confident that they can maintain payroll without further government relief. Okay, they will not be able to maintain payroll without further support from the government. And then also, the next slide shows that 83% of our clients reported that they could use additional capital over the next 6 to 12 months. And while the majority say that they would use it for payroll, we also see that there is a very strong need for rent support, for inventory, equipment, utilities, and other expenses of the business. So I think that it's very important that we are innovative, that we provide flexible, low-cost, long-term capital solutions, in addition to grants and other support. I love the public-private partnerships. It doesn't have to be all government programs. It really works very effectively when the whole ecosystem comes together and is really thoughtful, intentional, and creative about how we serve the needs of small businesses. And so I think that we want to be able to continue, because what we're going to see is that we're going to start to really see equitable recovery. If that's what we're really talking about here, equitable recovery, then we have to make sure that those populations and those communities that were disproportionately impacted by the pandemic are prioritized. That means they get immediate capital, the lion's share of the capital. And that is how we start to reverse some of the historic inequities and barriers that have been persistent in minority communities and those that have been faced by very, very small businesses that are out there. So we too are so appreciative of Calvert and all of the partners that have come together to ensure that there is an equitable flow of capital going into low-income and minority communities. The impacts we will see is a stronger economy and stronger communities everywhere.
Great. And this last question is for all of you. So what do you think the pandemic and the various responses to it could mean for the economic equity, for good and for bad? If we do nothing, we'll be worse off than ever before. But if we seize this moment, can we truly make things better than before? And I'll just kind of mix things around and I'll ask Beth to go first.
Yeah, I mean, I think that's really what gives me hope going forward, is that I am hoping that we have hit rock bottom and that we have nowhere to go but up. I'm hoping the recognition of these challenges, the intersection between the public awareness around the racial wealth gap, economic equity, economic mobility, historic discrimination, structural racism, and discrimination against gender-based issues. You know, those are all coming to a head in this moment, and I think that paired with the broader trends of our banking industry over the last 15 years, which has just moved further and further away from communities, from local businesses, from people. You know, I think we have a real moment to come together as an economy, as a society, with leadership from all three sectors, public, private, and government sectors, to really reimagine what our financial system looks like and who it works for. And I think that's the opportunity of this moment. And it's really up to all of us to make sure that we seize on that opportunity.
Thank you, Beth.
Yes, I am too very hopeful. I think that between, the pandemic and its economic consequences and the heightened awareness of the structural racism, the gaps in equal access to the resources that these small businesses and communities need to thrive, I think there's a bright light that has been shown on some of the worst challenges in our society. And there is a lot of momentum to create change. We don't need to let this crisis go to waste. And if not now, when? And if not all of us, then who?
Thank you, Liz. Aisha?
Well, I will echo both of my esteemed colleagues here by saying that I'm hopeful. I really am. I think that we're at a turning point. I visit the Hill often, and for many years I would speak with our representatives, and they couldn't put the acronym CDFI together. And now we're at the forefront. And I think as long as we keep CDFIs in the mix and really at the forefront of this rebuilding, then we're going to see capital get to the communities that need it the most. I really think that the focus has to be on resiliency right now. I spoke at the very beginning about the extreme unpreparedness of minority businesses, immigrant businesses, very small businesses. And so if we start to put some resources toward helping businesses to become more resilient, if there is another pandemic, if there is another disaster, we know that it could be just a very bad storm. It could be a blackout that could really, cause a business to shut down temporarily or permanently. So if we start focusing not just on capital, but building resiliency for these businesses, then we have a much brighter future ahead.
Thank you, Aisha. And I have to say before we wrap up that it definitely gives me even more hope, and it's so inspiring to hear all three of you with your experience, with all your commitment to really help those businesses that need it the most right now. So if we have more people like you, and just with you out there, it's really a great feeling of we are moving in the right track. Thank you so much for all the work that you are doing for small businesses, for the ones that need it the most right now. So thank you to our panelists, and this concludes our panel discussion. Thank you once again to all of you for taking the time to be with us today, and for all the work that you are doing every day on behalf of on and underrepresented communities across this nation. As I mentioned, your work is vitally important, and we really thank you for it.
Likewise, Carolina.
Thank
Likewise.
you.
Yes, thank you.
Thank
you
you.
all.
Thank you.
Hello. Hello again. So we're back here for our Q&A section. This was such an inspiring panel. It's always so good to hear all the amazing work you're doing. And please, I want to invite everybody in the audience, if you have any comments or questions that you'd like to ask Luz or Beth or Aisha, please send it through our chat in the comments section. We do have one question right now in our chat, and this probably goes more, I mean, you're all open to answer this one. Does a CDFI have more lenient criteria than banks, and how do they manage the risk? Luz, do you want to get us started?
Sure, I'll get us started. Good afternoon, everyone. So I say absolutely. I mean, I think CDFIs, like other lenders, look at what I call the 4 C's of credit: the character, capacity, cash flow, and collateral. When underwriting credit, character is critical. So we put a lot of stock into the relationship that we hold with our clients. When you know someone and and they know you, and when you say yes to a funding request, that really earns their trust. And it means that we get paid back, 94% repayment rate. I think we also look at the capacity. It's very important to be able to underwrite every loan to ensure that the borrower can pay it back. It really doesn't help to put a business into a loan that they cannot afford. And, sometimes the number one reason why businesses go out of business is because they either cannot access the cash that they need to support the business, or because they're accessing cash that has terms that are very detrimental to their business. So capacity to pay is really important. Cash flow is extremely important, particularly for smaller businesses. For those who are not operating with a CFO or an accountant that's preparing their financial statements regularly, but are operating in a cash economy, underwriting can require some effort on part of the CDFI in order to get an accurate picture of a business cash flow. So having the ability to spend the time with a business owner, understanding what their cash flows are, is also really important. Collateral, CDFIs understand that a lot of small business owners do not have the collateral to put up for a loan. And so CDFIs will work with the owner, and in most cases will make loans that are unsecured. Also CDFIs loans are generally fixed rates. I think that's important because that way the payment amount doesn't change. The business owner has certainty every month that they're going to have a fixed payment on their loan. Loans generally do not carry prepayment penalties. Which means that if the business owner comes up with a little bit of more cash one month, they can pay off the loan early and don't have to incur any penalties. And then you see that CDFIs also report to the credit bureaus. We have this responsibility to work with business owners to ensure that they build good credit. And the way to do that is making sure that they understand that the loans need to be paid on time, what the impact to the credit scores are. In other words, provide the cash, but also provide the coaching and the counseling and the technical assistance to ensure that that loan becomes a successful loan. And then last but not least, from time to time, we all get into trouble. And COVID was a real example of this. So during those difficult times, we work with our clients to restructure the loans, to refinance the debt, and always make sure that they're matched up with a free coaching mentor assistant that can help them with any questions or any needs that they have to move their business forward.
Sure, I'd like to respond to that as well. I don't typically say that CDFIs are more lenient, but what I do say is that we're more innovative in the way that we design our loan programs and that we're more flexible in our underwriting. and our due diligence of small businesses. And so, for example, we'll work with businesses that banks have historically shied away from. One of those might be contractors, right? Banks say, oh, we don't want to lend to contractors because they'll take the money that they receive from one project and they'll put it into another project instead of paying us back. And so, we will work with the contractor to get an assignment on the contract so that the proceeds come directly to the CDFI. So that's one way. Banks have historically relied on historical financials, past 3 years. So first of all, if you don't have 3 years of historicals, then the bank says you don't have enough time in business. But CDFIs have gotten comfortable working with businesses with a shorter operating history by looking at projections. Tell us what you're going to do based off of your customer, your purchase orders, your contracts, the way that you've made traction thus far. We're willing to take some more risk in that area. And so I think generally speaking, when it comes to credit scores, we're more concerned about the pattern of activity in the credit report and not the credit score. Whereas many financial institutions rely on a credit scoring model where they won't even really have an opportunity to ask you questions. We're really making sure that we do this manually, or at least that we have a manual review process after things are scored, so that we can understand what's happened. And generally what we find is that the business owner, if they have some problems with their credit scores because they weren't able to pay themselves because they're paying their employees instead. And so we try to help them with the cash flow to avoid those problems going forward. And we're seeing that our clients, their credit scores go up once we start lending to them.
And it's interesting because one of the ways that I've always heard about CDFIs managing risk is about what actually you both touch on, is really all the hard work and very hand-holding that you do with the small businesses, right? And you mentioned in your presentation, all of you, how building that healthy and thriving ecosystem of support for the small businesses were such a key factor for you to be able to support more and more businesses. So I was just wanting to kind of follow up on that, and maybe you can share with the group about how were you able to build that ecosystem as you were putting together the PPP product, right? Is that something you are providing those hand-holding, you are just partnering with several programs, and how is this support of the ecosystem really able to continue growing moving forward? Luz, I see you ready. Go ahead.
Sure. Yeah, I mean, absolutely. What has been mentioned in this panel, capital is very important part of the equation to help small businesses owners succeed, but they really need access to networking opportunities and expert advice to help overcome some of the key challenges that they're facing, particularly, over the last year. Business owners might be experts in their craft or trade, whether it's making, tamales or fixing a car engine, but they might not know about bookkeeping or building a business plan or the financial projections on how to get capital or negotiating a lease with their landlord. And that's where CDFIs can step in and provide support and connect them with experts. The small businesses that we serve also tell us that it's not simply the information alone that they find useful. It's also the feeling that someone has their back and cares about them, understands them, and is there to support them through their ups and downs and connect them with additional resources. And it's really more than a transaction. It's a relationship. It's helping the business owners build the confidence that they can do this and that we have their backs.
Yeah, I can't agree with Luz more, and I was going to address that. AEO did a report where they laid out for Black-owned businesses, there's a wealth gap, there's a capital gap, we all know that, but there's a trust gap. And that's really where we're failing our small businesses, particularly those that are led by people of color. And so when we work with our partners, and our partners are on the ground, and they have a relationship with the local small businesses, and they let them know about CDFIs, because CDFIs don't have branches, right? We don't have retail operations. You don't see commercials about True Fund, right? But when a local organization, a local small business serving, a chamber, for example, says, hey, there's a financial institution that's not going to say no as soon as, they hear your request. They're going to sit down. They're going to make sure they understand your request fully. They're going to assess all of your documents. They're going to provide you with the technical assistance and business advisory support that is needed if you're not quite ready for a loan, or they'll continue to work with us so that hand in hand, we help to make your business stronger, over the long term. And so that trust really does go a long way.
Beth?
I was just going to say, there's a question in the chat. I didn't know if you wanted to.
I was going to ask you right now if you wanted to take that one, actually. So do we have a question about, aside from many small business being unbanked and underbanked prior to the pandemic, was there any other factors you saw that led to difficulties in receiving PPP funds?
Yeah, and I think a lot of it's been touched on by Luz and Aisha in the presentations. I think relationships was a huge issue. So not being able to know who to turn to, who to call. The need for assistance with understanding the application and what documentation was required was a major challenge. And then things that a lot of people don't think about, which is when the federal government runs a program through the SBA and large banks, typically there are citizenship requirements, or at least perceived citizenship requirements. There are requirements that you can't have a criminal justice history or perceived questions around criminal justice history. And so I think that, in the haste of getting that program set up, that kind of equity analysis, wasn't completed, and there were a lot of challenges with connecting people that were otherwise disconnected.
Thank you, Beth. So we have another question in the chat, a little bit more about how New York had legalized cannabis under a historical bill. And they're really wondering, if I am reading correctly, how the financial system is adapting to meet the needs of this industry. And many other states are looking to become more equitable, but it's really hard to kind of provide services to this industry as well. And how are the banks actually supporting ancillary businesses in this new industry? So I'm not sure if maybe, I know California cannabis is legal, but I haven't heard much about it. I don't know if any of you would like to take this question.
Well, it is legal now. The only thing that I can say is that I think we're watching, we're learning. We certainly understand the injustices particularly for Black and Brown people, for very, very poor people, for the consequences that they may have faced for having just a modest amount of weed in the past, and so we see a lot of activity and a lot of advocacy in the communities that we're serving, encouraging us to lend to cannabis businesses. And I would say that we're not at the point where we're considering any products around that, but we're watching, we're listening, we're learning, and willing to engage in dialogue about it.
Yeah, I think it's going to be a really interesting continued challenge because a lot of the sources of capital that come into the CDFIs will not allow that activity if it's against federal law. And so I think this conflict between state laws and federal laws has been exacerbated in the financial system, and there are huge challenges with these businesses lacking access to financial services, just pure cash management, security, and other access issues. And so, I think it's going to be tough for financial institutions like the ones on this call to, who get sources of capital from all sorts of large other large institutions to be as flexible as might be required. But I'm sure that we will see innovative solutions within the industry soon.
Thank you. And I think we have a few more minutes left, and I'd like to just ask all three of you if we have a wide range of people in our audience. So if you had the opportunity to ask for a wish kind of thing that could help really support more equitable distribution of capital in the society, what would that be? It's like, I'm just curious to hear that from all of you. So Lucy, you want to get started?
If we had one wish from the banks in the group that could support more equitable distribution of capital, what would that be? That is the question, correct?
That is.
We would ask the banks to look at CDFIs capital structure on a risk-adjusted basis, as opposed to having all capital and all assets given the same kind of rating. And what I mean by that is nonprofits have a 20% net asset ratio, meaning for every dollar that we borrow from banks, we have to raise 20 cents in net assets. And cash are assets, which count against our equity. So for every dollar in cash that we hold on our balance sheet, we have to put 20 cents of capital. And so that would be something that if the banks came together and started looking at us, like the regulators look at, financial institutions, which is our capital on a risk-adjusted basis, it would give CDFI significant flexibility in being able to expand their lending and leverage their balance sheet further.
Thank you, Luz. Aisha?
I hate to say what she said, what Lou said, because I was just in a meeting about this with our CFO. But that really does hit it right on the nail. I would say, beyond that, if we were to look again, and I mentioned this during my remarks on the panel, we really need public-private partnership. We really need for strong strategic alliances and big thinking around these problems. We've got a lot of siloed programs. You've got even to the point where you've got competition happening for capital when that shouldn't be the case. We should all be working together. There's more than enough need that's out there. That's one of the reasons why I love the New York Forward and SOAR programs that are bringing together. I think we've got 13 lenders, covering the Southeast, the Southern region. There was no need to have one lender, right? We're all there. There's more than enough need. Let's figure out how we can get all of the funders to come together, and let's come up with some equitable solutions that can be applied across the country. So more listening, more collaboration from banks, from corporations, and from government.
Thank you, Aisha. Beth?
Yeah, I would say just everyone to just pay attention to your finances, where your money sits, where it goes, how decisions are made, who holds power in those decisions. I find that if we are going to have any opportunity to create a more equitable financial system, we all need to be more active with our money and talk about it and understand it and really hold that power and maximize the impact of that power. I think of finances as akin to voting, and everybody thinks that their dollar is not going to do anything to move the global financial system. It's the same thing about thinking that your vote doesn't count, and we are only going to see systemic change if all of us really understand and own that power. And so, I think that, that whether you're in the financial services industry or not, whether you have $1,000 in a checking account or $1 million in a savings account, that all matters when we talk about the direction that our global financial system and economy is going in. And so it's just a little PSA to pay attention, understand it, and vote with your voice and make your voice heard.
Well, thank you all again. I think this concludes our panel for today. We are right at like a minute after, but it was such a wealth of information. Thank you all for joining us today, to our panelists and to our audience for being with us today. Have a great day.
Thank you.
Thank you. It's been a pleasure. Thank you.
Yeah.